The post-COVID euphoria among fast-moving consumer good companies is over. The pent-up demand is long gone and consumers are clamping down on discretionary spending thanks to high inflation and growing input prices. This was intensified by global headwinds. More recently, unseasonal rains during the summer and the erratic southwest monsoon have made matters worse. The renewed rise in input prices added to the woes of FMCG companies and slowed the demand across the consumer goods universe, from home appliances to snacks, shampoos, and personal computers. After growing about 25 to 40% year on year in the second half of 2020, consumer goods companies are now finding it hard to remain in the black. Data shows that FMCG sale volumes contracted in 2022 largely because of the steep decline in rural demand. It saw a slowdown in urban markets too. Between the March and December quarters of 2022, sales volumes in rural areas shrank by 6 to 10% year on year every quarter. Brokerage firm Centrum points out that demand in semi-urban areas was impacted due to inflationary pressure on consumer spending, leading to lower footfall across stores. However, with the festive season round the corner, brands are now bracing themselves for a spike in demand. In a recent interview with Business Standard, Russell Grandinetti of Amazon said that the company is expecting this year's Diwali to be the best in terms of sales. Consumer sentiment for electronic products seems promising. A Counterpoint survey found about 85% of the respondents were interested in purchasing products like air conditioners, refrigerators, laptops, etc., of which smartphones topped the list with more than 50% interested buyers. In fact, most companies had anticipated a quick revival of consumer demand in FY24, with the festive season acting as a prime booster. But now they are switching to a more cautiously optimistic outlook. HUL had reported a meager 3% growth in volumes in Q1 FY24 on a low base, the lowest since June 2022 quarter. While it reported a 7% rise in net profit, its sales grew by 6%. Mumbai-based Marico Limited reported a 3% decline in its operating revenue to Rs 2,477 crore due to a 5% fall in domestic sales as edible oil prices crashed. Dabur India was more resilient. Backed by strong volume growth, Dabur reported an 11% jump in its operating revenue to Rs 3,130 crore. So how exactly will inflation affect the FMCG firms?
So the prices have started cooling and it was like a one-off event. So we continue to track this, that if the vegetable prices are under control or not. The festive season, if you look at the Onam demand and all that, the overall demand has been considerably good. So we expect that for the Diwali as well.
See, we've seen CPI increase while WPI has not, and therefore the upside to pass on price increases is going to be limited for FMCG companies, right? And given the increase in both commodity prices as well as packaging and logistics cost, we will see that there will be pressure on FMCGs. Typically, if you look at any FMCG, about 60 to 70% of its cost is cost of raw material, right? And therefore, to that extent, they are impacted when commodity prices go up. And hence, we will see them unable to pass on that benefit. It's also the festival season. So typically, these are quarters when there is high demand for items which consume a lot of wheat and vegetable fat and sugar, right? And therefore, given that demand is going to be high, we will see limited impact of price escalations from an FMCG standpoint.
And what measures should firms adopt to shield themselves from the possible headwinds?
So for FMCG companies, the three considerable steps that they should be taking for the future. First is the rural focus should be on the forefront, as that is going to help them to drive their volumes back with a higher focus on the small priced units, which is the small price packs, And then it would be the decrease in the grammage sizes, which is important to keep the EBITDA margins and gross profit margins in check.
I think one of the biggest tools is to look at data and analytics, because they do have access to a lot of data, and one big area where there is saving, like I told you, 60 to 70% of the cost is cost of raw material, right? So can you use AI ML models to drive down the procurement cost? The second area, of course, is to look at the festive season as an opportunity to bundle products, right? So can you come up with a set of offerings which are relevant to consumers during festival season by using bundling as a strategy.
As price rise remains the easiest way to tackle inflation, FMCG companies are steering clear of a knee-jerk reaction. Instead, they are reportedly squeezing margins, prioritizing key stock-keeping units, and rationalizing expenses. While FMCG firms are looking forward to the festive demand, experts point at the need to shift focus to small-priced units and revive rural demand.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.